I spend a lot of time in my declining years explaining, as you do, the efficacy of owning precious metals to young people. JP Morgan Chase, as an example, suggests that precious metals comprise less than 0.5% of the total savings and investment assets of Americans, down, by the way, from a 4-decade mean of 2%. The first lesson there is that if the rest of the things we talk about for the rest of our interview come to pass, it is likely that the market share of gold at least reverts to mean or perhaps overshoots. I'd like your audience to first of all think about what a 4-fold increase in demand would do to price. I'm not smart enough to give you the answer to that, but I leave it to you to use your imagination, understanding that prices are set on the delta between supply and demand. Imagine the potential impact of a 4-fold increase, which is merely a reversion to mean. Interesting points to ponder. JP Morgan Chase suggests that over the last 4 decades, the median or mean market share of precious metals and precious metals related securities relative to all other asset classes was 2%. Now it's 0.5%. So if gold gained enough favor merely to return to its average market share over the last 4 decades, demand for the stuff would grow 4-fold. Now they counterfeit 100% of the value of the currency. There was a time when they clipped the edges or they changed the alloy. But governments are much more efficient than they used to be. They steal wholesale as opposed to retail now. If you look at the other promise to pay, which is to say a U.S. dollar, literally, it used to be a package of dreams painted on a piece of paper. Now it's a packet of dreams clicked into existence. And it's really important, I think, that people know that. Not that the dollar will cease to function as a medium of exchange, but it's an increasingly inefficient medium of exchange if you also ask it to be a store of value, Robert, as you know, but many people don't. It's interesting that you talk about all other forms of exchange as debt, because I think for Americans, debt is the concept that will lead to the best understanding of gold. At the Rebel Capitalist Conference, Gorman's conference, I talked about the math of America. I talked about the fact that our on-balance sheet liabilities exceed $37 trillion, which is now, 120% of GDP?
Right.
In 1982, to put a large number in context, on-balance sheet liabilities were only 32% of GDP. So we've gone from 32% of GDP to almost 130% of GDP. It is estimated by the Congressional Budget Office, not some cranky old libertarian, Rick Rule, but the Congressional Budget Office. It's estimated that the net present value of unfunded entitlement programs exceeds $100 trillion. Now, again, this number in 1982 was about 90% of GDP. Now this number is 350% of GDP. And the math gets a little worse, Robert. I really want your listeners, I know math is boring, but I want your listeners to listen to this. The IRS estimates that the private net worth, the aggregate private net worth of all Americans, is about $141 trillion. And if you add the on-balance sheet debt of the U.S. government with the unfunded off-balance sheet debt of the U.S. government, that number is 130 trillion. So you take what we're worth, 141, minus what we owe, 130, there's only 11 trillion left over. Now, how do we get out of this? What I figure we do is we preside over the devaluation of the U.S. currency. We have a dishonest default. And that's where gold comes in. Gold for decades, for millennium, has been a medium of exchange that's simultaneously a store of value. It's been a place that you go when you don't trust government debt.
Right.
And the math suggests that this is a wonderful time. People on shows like this for a long time asked me when gold was going to move. And I'd scratch my chin sagely, Robert, and I'd say, well, I think gold's going to move in the year 2000. It's up 9% compounded for 25 years. Gold is two things. Gold is about not getting poor slowly. And if you're aggressive, and if you can afford to be aggressive in silver, which tends to outpace gold when a bull market really truly gets underway, and if you're willing to work hard and invest in the gold stocks or silver stocks, which tend to even outpace the metal, albeit with much greater risk and much greater volatility. What you say is very, very, very true. Anybody who looks at the graph of the XAU or any of the gold and silver indexes understands that when you move into a real precious metals bull market, the upside volatility is unlike almost any other financial market on the planet. One of the things I do is I maintain an alternative statement of account as a thought exercise, and I have since the year 2000, measuring my income, my net worth, and my expenses in both gold and dollars. And if you do that, what you're struck by is how cheap food is, how cheap gasoline is. If you measure it in the golden constant, price of gold was at $250, $255 an ounce in 2000. You're astonished by the difference in value between your gold savings and your dollar savings. Biggest single experience with political risk that I've ever had personally was discovering a mine that went on to produce 2 million ounces of gold. Sadly, in the People's Republic of California, 7 miles on the wrong side of the California-Nevada line. And that was an experience I will never forget. I've actually personally been treated better in Congo than California. Basically, I agree with you about the American concept of the rule of law, but I would prefer myself to be in Texas, Wyoming, Nevada, or Alaska, as opposed to the other states. Precious metals bull markets are led by gold. They're led by physical gold, and they're led by fear buyers. They're led by people.
Pessimists.
Maybe pessimists, maybe not. Just people who don't like the arithmetic of fiat currency denominated securities. I'm one of them.
Yeah, me too.
When the momentum in the bullion begins to expand the producer's margins, the big gold stocks move next. And we've seen that. Franco, Wheaton, Agnico Eagle, they've all doubled in 12 months. At some point in time, that movement, that momentum attracts the generalist investor into the gold space. And the gold space is so small, it can't accommodate the money. When that happens, leadership goes from gold to silver. And by the way, you will not need Robert Kiyosaki or Rick Rule to tell you when that happened. It's a truly, truly, truly dramatic event. And then the end of the precious metals bull market is when the money trickles down into the junior miners and the junior producers. And those moves are truly insane. Playing it requires a lot of education. It requires a lot of discipline. I would suggest that probably 85% of the junior miners are valueless. But that 15%, they generate such robust performance that they had legitimacy and even luster to a very rough sector. You described the chain perfectly. Silver will come after when the generalist money comes down to the space. Our mutual friend, Doug Casey, described that event, the generalist money coming into the silver market, as attempting to siphon Hoover Dam through a garden hose. If you really begin to change the balance between the futures market and the spot market, and I'm not saying that'll happen or it won't happen, that's what the shortage is all about. Right now,
wasn't J.P. Morgan fined for playing games with silver?
You know, people say that the markets are manipulated. All markets are manipulated. It's just that the silver market is so skinny that the potential penalty, I don't mean governmental penalty, I mean market penalty for manipulation, is extremely high. I remember in the decade of the 70s when silver markets were manipulated up because that was the easiest way to manipulate them. And I suspect that trading desks will do that again. JP Morgan amongst them.